What if there was a hidden warning sign for economic recessions? A single number that could tell us a crisis is just around the corner. Well, today, we're diving into a really groundbreaking paper by Simon Gilchrist and Egon Zakrajšek that seems to have found exactly that.
Think back to the 2008 financial crisis. It sent shockwaves all around the world, and pretty much everyone was asking the same thing. How did we not see this coming? It really felt like a storm that just appeared out of nowhere. But what if a clear signal was flashing bright red the whole time, and we just weren't looking at it in the right way?
Well, it turns out the answer was kind of hiding in plain sight, right there in the huge market for corporate bonds. Now take a look at this chart. See that solid black line? Look at how it just skyrockets right before that shaded area that marks the 2008 recession. That's the signal. It was practically screaming that something was seriously wrong. So, for the next few minutes, we're going to put on our detective hats. We're going to investigate the case of this hidden economic warning sign. We'll figure out what it's made of and uncover why it's so darn good at predicting economic trouble.
Okay, so our very first clue is something economists call a credit spread. And believe me, it is at the very heart of this entire mystery.
All right, let's break that down. When a big company, think Ford or Apple, wants to borrow money, they issue a bond. But investors want a higher interest rate from them than they'd get from a super safe U.S. Treasury bond, right? That little bit of extra interest, that's the credit spread. It's basically the money investors demand for taking on the risk that the company might not pay them back. So the higher the spread, the riskier the market thinks that company is. Simple enough. But here is where the plot thickens. This is what's known as the credit spread puzzle. When economists try to explain these spreads just by looking at a company's actual risk of going bankrupt, their sales, their debt, their profits, they found something really strange. The numbers just didn't add up. A company's real-world financial health could only explain like a fraction of its credit spread. And that was the million-dollar question. If the spread isn't just about how healthy the borrowing company is, what other invisible force is pushing this critical number around? What else is baked into that price of risk?
This is where the researchers had a real breakthrough moment. They thought, what if the credit spread isn't one signal at all? What if it's actually two totally different signals that have been mashed together? They just needed to figure out how to split them apart.
So they dug into decades of data, comparing the bond prices of thousands of different companies, and they developed this really clever method to statistically separate the credit spread into its two core pieces. And in doing so, they finally solved the puzzle of what was driving that other unexplained part.
And here is what they found. On one side, you have the part everyone already expected, the actual predictable default risk of a company, based on its balance sheet. But on the other side, they uncovered something totally new, and they called it the excess bond premium. This was the missing piece.
And here's the crucial point. The excess bond premium, let's call it the EBP, it isn't really about the company trying to borrow money at all. It's all about the mood and the health of the lenders themselves, the big banks, the investors, the financial institutions. It's basically a measure of their collective willingness to take on risk. When the EBP is high, it means the financial sector is scared and they're pulling back, demanding a huge premium for any risk they take on.
This discovery was a huge deal. This new component they managed to isolate, the excess bond premium, well, it turned out to be the smoking gun. It's a direct measure of fear in the financial system.
And this graph just brilliantly illustrates its power. When the researchers plotted the EBP over time, they found this incredible pattern. Look at this. Every time you see one of those shaded gray bars, which marks a recession, the EBP spikes dramatically. It was acting like a near-perfect early warning system for an economic downturn.
And a spike in this fear gauge isn't just some abstract number. It has massive, real-world consequences. Their analysis shows that when the EBP suddenly jumps, it leads to predictable drops across the board. This isn't just Wall Street stuff. It hits Main Street hard, affecting company investment, stock markets, and even the whole economy's output.
So where is all this fear actually coming from? Well, this slide nails it. The solid line is our fear gauge, the EBP. The dotted line is a measure of risk for the big investment banks, the very heart of the financial system. Look at what happened during the 2008 crisis. They move almost perfectly in sync. This really confirms the theory. The EBP isn't about risky companies, it's about nervous banks.
Okay, so we found the signal and we know what it's measuring. But so what? What does this discovery actually mean for policymakers, for investors, for all of us? That's the really crucial next step.
Well, this research really changes how we look at the economy.
It gives central banks a powerful new gauge to monitor financial stress, and it confirms a critical idea. The mood on Wall Street directly hits Main Street. When the banks get nervous and slam the brakes on lending, when that EBB spikes, it can actually cause a recession that affects every single one of us.
So the excess bond premium gives us a crucial early warning. It's like having a much more accurate barometer for economic storms. But the ultimate question still remains. Knowing a storm is coming and having the tools and the political will to actually prepare for it, well, those are two very different things.